Hi, welcome back to Joe Blogs. This video is an update on the situation in Pakistan. If you've been following the channel, you'll know that Pakistan is currently sitting on the brink of bankruptcy. It's a net importer, has to pay to import fuel and food, and it's down to less than $4 billion of reserves. So that means that Pakistan has less than 3 weeks worth of cash left to keep the lights on. So in this video, I'll provide you with an update on the IMF bailout that is urgently needed. The IMF has just announced that it's agreed a deal with Bangladesh to release $4.7 billion as part of their bailout. So that one's done and dusted. Pakistan really needs the IMF to get onto their case and get theirs sorted. So I'll give you an update on what's going on with regards to that situation. We'll talk about what's happening with gasoline prices because they've just been hiked in Pakistan. And this is really linked to the IMF deal because the IMF has a variety of different requirements that it needs a government to put into place to make sure that it's on the right footing to get back to economic stability. So we'll talk through that and then what the implications of that gasoline price increase will be for the Pakistani people. We'll then have a look at what's going on with regards to the rupee because we saw a huge fall in the value of the rupee last week. So I'll have an update and see where we are right now. We'll have a look at Pakistan's debt because that's one of their biggest challenges to try to avoid a default on all of the international debt. We'll look at what's going on with regards to letters of credit and a new deal that's just been struck with Russia to provide fuel to the country. So that potentially could be another bailout situation. And then finally today I'll wrap up with my summary as to what I think is likely to happen to Pakistan over the course of the next month or so because we're on that sort of time frame. This isn't a 3 to 6 month job. This is literally over the course of the next 4 to 6 weeks. That's the critical period from Pakistan's point of view. And then what the implications of what's happening are for the global economy. So before we get started on all of that, if I could ask you for a thumbs up at some point during this video, that would be great. Please subscribe if you haven't done so already. Don't forget, I always include chapters, so if you haven't got time to watch everything, you can pick and choose what you'd like to see. And if you'd like to support the channel, please have a look below where you'll find links to YouTube Super Thanks and membership, as well as Buy Me a Coffee and Patreon. And as always, thank you so much to everyone that has supported the channel. Pakistan's Ministry of Finance recently announced that gasoline and diesel prices would rise by 35 rupees a litre, which is the equivalent of around 14 cents, after the country's currency value plummeted last week. The decision came days before an International Monetary Fund mission will visit Pakistan later this month to discuss the stalled 9th review of the country's current funding programme. Pakistan's finance minister said he hoped the announcement would dispel speculation on social media of a higher price hike or that gasoline supplies would run dry. He said the price increase was recommended by oil and gas authorities due to the higher cost of buying energy in the global market. We will have to take the rise in international oil prices and the devalue of the rupee into account, he said. Following reports that gasoline stations had seen long lines outside as residents filled their tank due to speculation that prices would soon rise, he said, "This rise is being done immediately on the recommendation of the Oil and Gas Regulatory Authority, who said that there were reports of artificial shortages and hoarding of fuel in anticipation of fuel price rises. Hence, this price rise is being done immediately to combat this." So just to clarify, the situation in Pakistan with regards to gasoline prices is different to what we see in the West. In Western economies, gasoline stations are owned by private companies such as BP, Shell, ExxonMobil, and they set their prices based upon how much it's costing them to buy gas in the international markets. In Pakistan, the gasoline prices are controlled by the state, and historically the price of gas has been set to try to make it more affordable. But the IMF has come in and said that you have to stop all of these price controls because basically this is a subsidy that's being provided by the state. So the Pakistani government are absorbing the difference between what it's costing to buy gasoline in the open markets and what they're selling it to consumers for. And the reason that the IMF wants this control to be removed is that they're trying to move Pakistan towards more of an open economy. So by increasing the price of gasoline by 35 rupees, the Pakistani authorities are moving more towards what the IMF is looking for and then hopefully getting the IMF comfortable that everything's now in place to be able to release the $1.3 billion that they need urgently for the bailout. So increasing the price of gasoline is a positive from that point of view when you're looking at it from an economic perspective. But when you're looking at it from a cost perspective for the people of Pakistan, this couldn't have come at a worse time because the economy is already in crisis. And the last thing that anybody needs is to see increasing prices right now when they've got falling income. This chart shows the movement in inflation over the course of the last 12 months, and you can see that this time last year, inflation was running at around 13%, which is a pretty high level. However, over the course of the last 7 months, we've seen a marked increase in inflation, and it's now sitting at 24.5%. Now, as you'll be aware if you follow the channel, following Russia's invasion of Ukraine on the 24th of February 2022, we saw a spike in oil and gas and food prices and other commodities all around the world. So when we've looked at the inflation data for other countries, we saw a real spike in March, April, May and June. Then we started to see the price of oil and other commodities coming down as the global economy started to slow down and we saw a reduction in demand. When you look at this chart, it's entirely different. Inflation did rise in March, April and May, but only by a very small amount. We then saw a large jump in June and July, and it's remained at a relatively static level since that point. And the reason that the inflation chart looks like this is because the Pakistani government and authorities are managing the price of a variety of products in the markets. So they're making sure that inflation doesn't get carried away with itself in the same way as we've seen in countries like Turkey and Argentina, where it's got up towards 100%. It's staying at a relatively flat level. But if the IMF now impose restrictions on the Pakistani government and say that they have to remove all of these price controls and the subsidies, we could see a marked increase in inflation over the next couple of months. And just to highlight that fact, this chart shows the movement in transportation costs over the last 12 months. And this is actually an index, so this isn't in percentage terms, this is an index. So the original index would have been 100 at some point in the past, and we're now measuring the price on a month-by-month basis compared to that original data point. And this graph has exactly the same profile as the data we just looked at for inflation. So in the initial 3 months after Russia's invasion of Ukraine, there was virtually no movement in transportation costs, which doesn't really make any sense because at that time, the price of oil was out of control. So we saw a huge increase in oil prices, which then fed through into transportation costs. But that didn't happen in Pakistan because the price was being controlled. We did see an increase in June and July. However, since that point, prices have remained flat, which again doesn't really correlate to what was happening in the international markets. With oil prices, we saw prices spiking at the end of June. And since then, we've seen a marked reduction in the price of oil. So if this chart was following what happened in the markets, it would have had a big spike in the front end and it would have been coming down over the last few months. However, we're not seeing that at all. We're seeing a controlled graph here. Now, following the announcement that gasoline prices have risen by more than 15%, that means that we will see an increase in the January figures. And the question then will be, how far will this go if Pakistan does move towards an open free market? This chart shows the movement in the Pakistani rupee against the US dollar over the course of the last 12 months. So you can see that this time last year, $1 equated to around 187 Pakistani rupees. Today, it's closer to 267. So the value of the rupee has deteriorated significantly over the course of the last year. And you can see that the general trend was a marked and steady reduction in value. However, there have been a number of different spikes. Back in August and September, the value of the rupee fell by around 10%. However, those falls were quickly reversed. And this was as a result of the Pakistani central bank stepping in and taking some action to bring the price back into line with where they wanted it to be. So this is basically market manipulation, whereby a central bank will step into the market and buy currency to support its own value to make sure that the value doesn't deteriorate significantly. However, if we look at what's happened recently, prior to the fall, $1 was trading for around 233 Pakistani rupees. And in the course of one day, we saw that value fall by almost 10% to 262 Pakistani rupees. And the reason for this was that the market controls and manipulation were removed. And this again is an IMF requirement. They want to see a floating currency. They don't want to see central banks managing and creating a false market. They want to see it moving in line with wherever the international trade markets say that it should be set. And as you can see, because the controls being applied by the central bank have now been removed, there has not been an immediate bounce back in the value of the rupee. And it's likely that we could see further deteriorations because what's happening in the Pakistani economy with regards to the potential debt default, they're unable now to make payments when they're buying in food and fuel. All of those factors combined are raising the risk of Pakistan going into bankruptcy, which makes the Pakistani rupee very unattractive. Nobody wants to be holding Pakistani rupees right now because if the country does collapse, if it goes into bankruptcy, then the Pakistani rupee could become virtually worthless. So this becomes a very vicious circle. As the price falls and things start to get worse in the economy, nobody wants to buy the currency, and so the price falls further, and so it becomes more expensive when Pakistan's having to pay for international products like fuel and food, and so it goes on. So this is a very difficult cycle to break away from, particularly now that the central bank has no influence on this price. One of the major concerns for Pakistan right now is servicing its debt. Pakistan has built up around 62.5 trillion rupees of debt, which equates to around $275 billion. And all of that debt carries a coupon, so they have to pay interest on it, and they also have repayments of bonds coming up. It's been reported that by the 30th of June, Pakistan needs to find $33 billion just to pay the interest on its bonds that are maturing. So obviously it doesn't have anything like that at the moment. The current account is currently sitting with $3.6 billion, and that represents less than 3 weeks worth of food and fuel that it needs to buy in. Now, Pakistan is currently in discussions with the IMF with regards to a bailout. However, that bailout is a $6 billion deal that was agreed in 2019. Now, of that $6 billion, $5.7 billion has already been released. But in 2021, the IMF agreed to increase it to $7 billion. So they gave them an extra billion of credit. However, over the course of the last year or so, the IMF has not released that additional capital because they don't believe that Pakistan have been complying with all of their requirements to try to get the economy back on track. So what we've covered off in today's video with regards to the increase in gas prices and the removal of the currency controls are part of the measures that the IMF want to see brought into place for Pakistan to be able to stand on its own 2 feet and build the economy back up. But unfortunately, there are more things that Pakistan need to do. And the IMF is visiting Pakistan for an update meeting between the 31st of January and the 8th of February. So they will go through everything systematically. So if we assume that that deal gets done, then Pakistan will be given another $1.3 billion, which it can then use to buy fuel and food. But obviously, that's nowhere near $33 billion that it needs to be able to stay current with all of its debt obligations. So the only way that Pakistan will avoid a debt default will be by meeting with all of the lenders and the bondholders and asking them to waive all of their requirements, all of their repayments, and to extend them more credit. So that is their only hope. Realistically, it's going to be quite difficult to be able to do that because they've got a very short space of time, firstly, to get the IMF deal done, which is the first and foremost thing that they need to get on the board. And then secondly, to get all of those bondholders and banks and lenders to be able to agree to this extension of credit. So I don't know whether or not they'll be able to get there. I think they're getting their ducks in a row. They want to get this IMF deal over the line first, and then they'll focus in on the debt. But there is a very strong possibility that Pakistan will default on its debt, and if it does, it may find itself in a similar situation to where Sri Lanka was a few months ago. They defaulted on their debt. They basically said there's no way that we can make any of these repayments. Therefore, they didn't have any credit, and they were struggling to be able to get deliveries of fuel and food into the country. And Pakistan could go down a similar road to that. They will have some money from the IMF if they can get it, but obviously that money will not last forever. Pakistan needs to get itself back into the black somehow. Now, historically, Pakistan has not had a strong trading relationship with Russia. But if you've been following the channel, you'll know that Russia is currently looking for new trading partners. It needs to find buyers for its oil and gas products because the EU has placed bans on a variety of different products, and there are more bans coming over the course of the next week or so. And Russia have now announced that they've agreed deals to provide gasoline and oil to Pakistan. Independent Russian oil refiner Fortinvest has announced that it's agreed a deal to send Russian oil to Pakistan by land for the first time. An initial deal to supply 1,000 tonnes of gasoline has been agreed, and this will be shipped firstly by rail to Afghanistan and then reloaded into trucks and driven through the border into Pakistan. Alongside this deal, the Russian energy minister recently met with Pakistani officials with a view to agreeing deals for crude oil sales. In a recent interview, he told reporters, "As for the supply of crude oil and petroleum products, we conceptually agree on the development and signing of an agreement that will determine and resolve all issues of logistics, insurance, payment, and volumes." He said that the two sides had established a timeline of late March and that negotiations are going on about the settlement in terms of currency. Following up on this, the Pakistani junior oil minister stated that Pakistan wanted to import 35% of its total crude oil requirement from Russia and stated that if we have dollars in excess, then we are ready to do trade in dollars. And if there's a shortage of dollars and we have some other currency in our reserves, we are ready to trade in that. All of these things will be finalised in the next 60 days so that by the end of March, the oil supply starts from Russia. Russia's energy minister went on to state, "We have decided that it would be a good idea for Pakistan to approach Gazprom and Novatek, the two largest LNG producing companies in Russia, in late 2023 to discuss the conditions when they have spare capacity. So I think this is a really interesting development. From Pakistan's point of view, this is great news because they desperately need an influx of oil at the moment and they're struggling to be able to make their payments. So signing up a new agreement with Russia in whatever currency they can is the right way forward. So they're looking to secure those future supplies. And as you just heard, up to a third of all of the oil that's needed by Pakistan could be coming from Russia by the end of this year. Now, when you look at the flip side of this arrangement, it does look a little bit unusual because Russia is agreeing to supply a country that is sitting on the verge of bankruptcy. So if you were a company and you were looking to sign up a new customer and you could see somebody that was about to go bankrupt, that probably isn't the sort of customer that you're looking to sign up because it's just going to cause major headaches. They're not going to be able to pay you. You're going to give them all of the supplies and then you're going to have to chase up for those payments. But Russia's in a desperate situation at the moment. They've lost all of their crude oil sales from seaborne deliveries in December, and they're now facing the refined products ban that's coming in on the 5th of February. And in addition to that, they've also got the two price caps, the crude one that was put in place on the 5th of December and the refined product price cap that's coming in on the 5th of February. So Russia is currently losing customers all over the world, and it needs to find friendly nations who are happy to take its oil because it needs to keep those production levels flowing. So from that point of view, it's good for Russia that they can supply Pakistan because it means they can keep their volumes up. But from a revenue point of view, there's a big question mark as to whether Russia will actually get paid in cash or if they're going to have to just provide lots of credit facilities. And if they do provide a lot of credit, then the question will be, what will Russia do in the event that Pakistan can't pay? Will they look to enforce in other ways? Will they look to try and develop more of a relationship with Pakistan? Or will they just wait until Pakistan has enough money to pay them back? So what's the summary and conclusion today? Well, I wanted to post this video really to give you an up-to-the-minute update on what's going on in Pakistan. And what we're seeing is that the Pakistani authorities are starting to agree to all of the conditions that have been set for them by the IMF in order to access that $1.3 billion that they urgently need. So they've now released all of the controls on the currency, and as we saw, the result of that was a dramatic fall in the rupee, and it's still falling now. We haven't seen the bottom of that market, and as the situation gets worse in Pakistan, it's likely that the rupee could continue falling over the next week or so, and this becomes a very vicious circle in terms of it reduces the purchasing power of Pakistan because they're buying things in the international markets in dollars and they have to then translate all of that back into rupees when they're setting prices in the home market. And as the value of the rupee falls, everything internationally becomes more expensive. So it is quite a difficult conundrum. And in addition to the rupee controls, we've also seen now gasoline prices being raised because the subsidies that have been applied by the authorities aren't acceptable from the IMF's point of view. And of course, raising gas prices causes problems for the people in Pakistan because transport and fuel costs are indiscriminate. Everybody needs transport to do things, whether it's going to work or school or whatever it might be. So when those prices go up, it affects the poorest people as well. And if they can't afford to fill their vehicles, then maybe they can't get to work, they can't do their jobs, and that puts pressure on their income. And as we saw, inflation is already running at high levels, 24.5%, but that's with controlled prices. If those price controls have to be released, then that's going to drive up inflation further and going to put more pressure onto everybody. And in Pakistan, around 50% of the people are living at or below the poverty line. So that equates to around 110 million people. So that's a lot of people. But unfortunately, the authorities in Pakistan don't really have much choice because they're running out of options. The IMF bailout is really their last chance. They haven't got any other options of bringing any more cash in. So they need to get that deal done. So whatever the IMF tell them they need to do, I would bet that over the course of the next week or so, we will see Pakistan agreeing to that to get that cash in the bank. Now, once that money's in the bank, that will give them a little bit of headroom in terms of food and fuel supplies. But in terms of their debt, they are staring down the barrel. $33 billion of interest and repayments coming up by the end of June is impossible for Pakistan to be able to pay. So they need to start negotiating rapidly to push out all of those deadlines and give them more breathing room. If they can't do that, then Pakistan will formally default on its debt. That means that they will be downgraded further. It's likely that the rupee will fall in value further. That will increase the price of everything that Pakistan's buying in the international markets, such as fuel and food. Therefore, it will drive up inflation and cause even more problems. So you can see it's a really vicious circle. So Pakistan really need all their bondholders and lenders to waive all of those payments and to give them extended credit. Now, in terms of the positive developments, the news that Russia is now supplying gasoline directly to Pakistan and they're in negotiations to provide crude oil is obviously good news from Pakistan's point of view, because they need some friendly suppliers to keep the fuel coming in, to keep the lights on, to keep industry actually moving, to generate some GDP, to try to get the economy back on its feet. So this is good news from Pakistan's point of view. But as I mentioned earlier, there's a question mark as to whether or not this is a good deal from Russia's perspective. It's good that they can keep volume flowing, which is one of their objectives. But obviously, President Putin wants to keep revenue coming in as well. And whether or not Pakistan has enough cash to be able to actually make the payments for all these fuel deliveries remains to be seen. So the overall summary from Pakistan's point of view is that the situation remains critical. They urgently need some cash. They're desperately trying to do everything to bring it in, but the clock is ticking. Time is running out. So over the course of the next week or two, we will know whether or not the IMF is happy, whether or not they're going to release that new cash. And if they do, that will give Pakistan some more breathing space. If they don't, then Pakistan will go into bankruptcy, it will default on all of its debt, and we will see a collapse of that economy. Now, in terms of the impact of all of this on the global economy, well, as I've said a million times before, the global economy is interconnected. So what happens in Pakistan will have a knock-on impact to the rest of the world, because Pakistan is buying lots of things from lots of different countries. So if Pakistan does get to the point where it runs out of cash and can't make any payments, that means that all of the countries that have got trading relationships with Pakistan will lose those relationships. So that could then potentially cause knock-on problems, because if those companies don't get paid, they may have their own cash flow problems, and then they won't be able to pay their suppliers, and so it goes on. So there definitely will be a domino knock-on impact. And of course, the IMF's funding comes from all of the countries of the world, and there is a weighting on the contributions. So the richer countries have to contribute more. So if the IMF continues to bail out Pakistan, that money will be funded from all of the member states, and therefore more capital will be going into Pakistan, and more capital will be needed to be called up from all of those different countries. So there will be a direct knock-on impact if this bailout does carry on. So obviously this is a live situation, and I'll keep you informed of any further news and developments as and when they happen. Hopefully you've enjoyed today's video. If you have, then please give me a thumbs up, and thank you for watching this video all the way through to the end.